Today in our Money Matters segment, we're talking about how to handle a volatile stock market. Whether you're new or experienced in stocks, the market can be unpredictable. And joining us in studio today is our financial expert, Ernest Burley. Thank you so much for being here, Mr. Burley.
Thanks for having me back.
So I'm new to the stock market. I know this can be a great money vehicle, investing your savings, but I know it's got some major highs and lows. Just a few weeks ago, there was a major hit to the stock market.
Yes.
How should you handle that? If you've got a bunch of money invested and you see something like that, what should you do?
Yeah, so the first thing you should do is take a look at the three questions. We've tackled this in a previous segment. You will find out, make sure it lines up with your current goals for the money, right? What's the purpose for the money? What's your risk tolerance on that money? And what's your time horizon? How long before you need to use that money? So make sure it still lines up properly and then go from there.
So a lot of times when you see a big crash, like, a change like that, your first instinct would just be sell, sell, sell. Let me get rid of this stuff. Is that a good idea?
Right, so we talk about that too. That's a losing strategy. That's a loser strategy. I shouldn't call people losers, but that means you bought high and you sold low. You don't want to do that, so I'm not going to rehash that. But if you sell when the market is low, but you bought high, that means you lost money. It's just a loss on paper until you actually sell, right? Yeah. So I don't recommend doing anything. You want to make sure you're properly diversified. So that's the right thing. Make sure you're properly diversified amongst various asset classes. So your investments are amongst different asset classes and you're not overly concentrated in one particular investment. So you don't want all of your money in one stock or all in real estate or in 2 or 3 stocks. You want to be properly diversified amongst various asset classes.
But if you do decide you want to pull out, sell, take your money out of the stock market, are there any other consequences besides just losing money on your investment?
Yeah, I mean, what some people do is, like, I have some clients, they've accumulated $1 million, $500,000, and they don't want to lose anything. They just want to preserve what they have. So in a case like that, the only way to remove that exposure is to pull your money out of the stock market. You can put it into like an FDIC bank product or a fixed annuity. So that's what you can do to preserve what you have and not worry about the volatility of the stock market, an FDIC bank product or a fixed annuity.
So you just mentioned FDIC. I'm always hearing that. You see that at the banks, insured by FDIC. What does it mean? What is it?
FDIC stands for Federal Deposit Insurance Corporation. So that means that particular money is backed by the full strength of the U.S. federal government. Now, fixed annuities are not FDIC insured. They're backed by the financial strength of the insurance company that you place your money with. So make sure you know the difference in the two. FDIC does not apply to annuities, only to the bank products.
So that's protecting your money at the bank. But, we had some stories last year, some major banks, collapsing. Silicon Valley Bank, for example. Let's say I had $1 million at that bank. Does that mean all of that is safe because they're FDIC protected?
Well, that's a good question. That's a lot of money in there. All right. So it's a limit. It's $250 per person. If it's a joint account, there's $500,000 of protection. All right. So if you have more than $250 in an individual, it's $250 per account, per ownership category, per institution. So you can open up accounts at various banks to make sure you're covered. So if you have $250,000, you take it to 4 different banks if you want a single account, right?
Right, yeah. Right. But if you did have more than $250,000 in that one account, what happens to the rest of that money in that scenario?
You're covered up to the $250,000, right? It's up to the feds to say whether they want to give you the extra amount, which I doubt, right?
Yeah.
So they let you know up front. That's why they have FDIC and the limit of $250,000. So don't put more than $250,000 in a single account. If it's a joint account, it's $500,000. So if you add someone to the account, I don't recommend just adding a person to your account to get that. Just open an account at a different bank. That's all.
Okay.
Yeah.
So you mentioned that FDIC, it doesn't cover annuities, correct?
Correct.
Does it cover credit unions?
No, it does not. But credit unions have something similar to FDIC. They have something called NCUA, which stands for National Credit Union Administration, and it's the same limit. It's the $250 for individual accounts and $500 for joint accounts. So it's very similar to FDIC, but it's not the same. Now, any type of mutual funds, like non-deposit products, like mutual funds, stocks, variable annuities, they are not FDIC insured, nor are they NCUA. That's in the market. So let's be clear on that. Those are investment products, not bank or credit union products.
Okay. So when it comes to the things that you've invested in the stock market, there's really no protections, correct?
Not really, because what you're doing is trying to get some good potential gains, but you don't know what a particular company is going to do. So you're invested in companies, there are all different types of things you can invest in, and you can't predict what it's going to do. But historically, the stock market gives you good potential for making gains over time. So that's where you want to go for the long term, for the most part.
All right.
Yeah.
Well, thank you so much, Ernest, for explaining that to me.
Sure.
Maybe I'll start
Do
betting on
it.
the market.
Do
I
it,
don't
Mariah,
know.
do it,
I
do
don't
it,
know.
do
We'll
it.
see. All right. Individuals should contact their own financial professionals and attorneys to help answer questions about specific situations or needs before taking any action based on this information.